Good morning, everybody, and thank you for joining our 31 December 2024 not-for-profit webinar. So as you are probably aware, if you've joined one of these, we do have these webinars once every 6 months. But before we get started, I would just like to do acknowledgement of country. So we begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. We extend that respect to Aboriginal and Torres Strait Islander peoples here today. Before we get started, I'm also just going to do some housekeeping. If you haven't used GoToWebinar before, so when you join, you are on mute mode. I do ask that if you have any questions, please raise those questions using the questions tab, and we will try and answer as many of those questions during the session as we can. If you have any technical difficulties, please click the support button and hopefully we can assist you. If you do miss any of today's webinar, we will share an email followed at the end of this session with all the presentation slides and a link to the recording session, and also a link to all of our previous recorded webinars, as well as the speaker's contact details. So I'm Elizabeth Blunt, and I am hosting today's session. I am BDO's national not-for-profit leader, and I am based in Melbourne, and I'm a partner in our audit and assurance division. You won't just be listening to me today. I do have Kevin Frovis with me, who is a partner in our advisory team, and he will be, and Kevin, you can come on screen now. Kevin will be providing us an update on the not-for-profit accounting updates and also ESG and sustainability. We have Oliver Straker, and Oliver, you can come on as well, so we can put a face to the name. Oliver is in our wealth advisory team, and Oliver presented at our last session, giving us an update on the investment markets, which most not-for-profits have, or a lot of not-for-profits have large investment portfolios. So it's great to get that update from Oliver. And we also have Brent Letson, who will be presenting on cyber. So Brent should come on screen in a moment as well. And Brent, so cyber is impacting a large number of organisations, but in particular, not-for-profits hold a lot of sensitive information. We also hear in our feedback surveys that cyber is a key topic. So we have Brent doing a talk about cyber as well and how it impacts not-for-profits. So what we might do is we might go straight into Kevin's presentation. So thank you so much for joining us today, Kevin. You have a number of slides that you're running through today, so I will hand it over to you now.
Thanks, Elizabeth. It is good to see you as well as Elizabeth, and good to catch up with you on this topic. And thank you for having me. I think, as advertised, this was meant to be Aletta Boshoff was headlining the act, but as you know, Aletta and I are sometimes completely joined at the hip. So whether I do it or Aletta, it doesn't really matter. But Aletta was unable to join today, so hopefully you'll be very happy to have me, and I'm very happy to be here. I will
I'm
be
very
talking about.
happy. I'm
Thank
very
you.
happy to have you, Kevin.
So I'm going to talk about sustainability and financial reporting, and this is a topic that has evolved quite rapidly in recent months and years across all the sectors, for profit, not for profit, and even in the public sector. So I'm going to do a little bit of a conversation about where sustainability reporting is up to more generally, and then we'll talk along the way how that impacts the not-for-profit sector. I'm probably going to talk about the public sector a little bit today. I personally see that as part of the not-for-profit sector, but I do understand that not everybody's in the public sector. So I will try and draw distinctions between, shall we call it, charities or entities that are private not-for-profits as well as public not-for-profits as we go. But in terms of the sustainability reporting update, I think the two key areas that are emerging rapidly is essentially the driver behind it, and there's really two drivers behind it. One is the strategic imperative, and then the other one is compliance imperative. Now, Elizabeth, there we go. Well done. Next slide is up. And you would have heard this if you've joined some of our other webinars recently. This won't be new, so I'll just kind of run through what this concept is. Why is sustainability important now? Really, two drivers. Um, what do things like ESG, environment, social, and governance have on an organization's sustainability or making it sustainability going forward? And really, the strategic imperative is driven by things like access to capital markets and people, which is the next slide, Elizabeth. Now, in the not-for-profit sector, access to capital looks very different than to the private sector. Access to capital is things like government funding, grants, but also just pure donations and philanthropic type capital. And I actually want to go and say that in the world of the not-for-profit, the strategic imperative for sustainability has probably been stronger than it has in the private sector for some time. Because let's face it, not-for-profit entities have always had to um, justify their case in terms of viability and purpose a lot stronger than perhaps the for-profit enterprises have. So I feel as if the not-for-profit organizations have a better handle on what we mean by strategic imperative, accessing your funding and capital, and accessing people to come and essentially buy into the purpose. And that's probably means that in some way the reporting around sustainability is probably a lot stronger in the not-for-profit. I work quite strongly in the community housing sector in particular. I've had some experience in the community housing sector, and I was always amazed and not surprised, but amazed at how their annual reports spoke better to things like social and governance issues, even before we get to things like financial reporting and mandatory reporting. Moving on to the next slide, then, Elizabeth, the strategic imperative that's driving sustainability reporting, as I said, is already kind of well developed in this sector. But where we're heading to now is the ecosystem is evolving, and we're starting to see the emergence of climate reporting in particular starting to emerge. And it's not always driven by mandatory or voluntary reporting along with financial reporting. It's sometimes driven by the fact that suppliers and customers are actually wanting to know this information as well. So the driver in terms of the strategic imperative might be that you're looking for access to capital and markets and people, or donations and grants or funding. But it's also now being driven, especially in terms of the climate topic on sustainability, by way of supplier and customer information. They want to know how you are managing your carbon emissions footprint, that you understand your place in the value chain, and in some cases they're actually asking for information so that they can actually monitor it themselves and understand their place in the value chain. So whether you are not for profit or for profit or public sector or not public sector, the strategic imperative to start to measure and evaluate carbon and carbon emissions and climate in particular is now starting to be driven by your place in the value chain. Most organizations have probably been asked at some point or another, or will be asked in the near future, for information about their carbon emissions, whether you are private, not for profit, public, whatever it might be. And most um, organizations in that value chain, whether they're a supplier or a customer to somebody in their value chain, will at least be asked their scope 1 and scope 2 information in the first instance, and probably qualitative information about scope 3. What are we talking about here? We're essentially talking about putting a number on your organization's emissions out into the atmosphere of carbon and carbon equivalent gases from your activities. And what are your activities? Direct activities such as burnings of fuels, purchased electricity in scope 2, and really input and output of carbon embedded in your services and processes, which is your scope 3. Now, we've been going along on this for some time. Um, But really, the high level considerations that you need to take into account going into your 31 December reporting period on this is on our next slide, Elizabeth, in terms of high level considerations. So, has your entity identified and measured all your greenhouse gases related to your activities and operations? That's almost a yes no answer. Um, have you been complying with greenhouse gas protocol? Either you are or you're complying with a variation of that. Have you had to consider top ups in terms of your measurement of scope 1 and 2? That's pretty much only going to be relevant to your heavy emitters. However, in the public sector, so I'm talking government agencies and departments, some of those organizations are already quite advanced in terms of not only their ENGA scheme reporting if they're a heavy emitter, but also in terms of their GHG measurement, because the public sector, and I'm going to use New South Wales as an example here, Treasury in New South Wales is also going to be required some of the disclosures for some of the larger agencies and departments for years 30 June to 2025. So the questions you really have to ask yourself is how far along are you and who's really asking for this information. The big thing when it comes to starting your journey on carbon footprint measurement is making sure that you've documented these considerations. What's in your boundary, what's in your scope 1 and 2 measurement, who's asking for it, who wants it to be published in a set of financials, and when is that going to happen? I think in terms of order of priority, most public sector entities will have to, at least in New South Wales, but maybe also at the Commonwealth, report this for the first time 30 June 2025. Most private large proprietary companies, which is not the subject matter of today's webinar, will have to do this in the next 3 or 4 years based on mandatory reporting at the Corporations Act level. And then really charities and not-for-profit organizations, they may not have a mandate just yet to actually put this in their financials, but you are definitely going to be asked, especially around your carbon emissions, because of either somebody in your value chain asking, so customers, um, and suppliers, or your investors. And in your case, investors in the not-for-profit space are your providers of capital grants and people who are actually providing donations. They're going to want to know what you're doing about this before they hand over the money. And that's essentially something that you need to consider going into the next financial year. I'm going to kind of jump ahead then, Elizabeth, and I might actually ask you to kind of skim through the next few slides. The compliance imperative slides that we've given you here are the ones that relate to the um, private sector. So this is Corporations Act. Not all or not every not-for-profit on this webinar today will be captured by this. In terms of the legislation for mandatory climate reporting, this really only applies if you're reporting under Chapter 2M of the Corporations Act, although some entities on this call, on this webinar, might be captured by that. But what is relevant here is that the trend towards compliance reporting in the body of the financial reporting is coming. The public sector, New South Wales, Treasury, and Commonwealth have already got mandates on when this is going to happen. The Corporations Act has been amended to capture Chapter 2M large proprietary companies, and next off the rank will then be the not-for-profits on this call if they haven't already been captured by it. So the slides that we've given you is actually what's applicable for the Corporations Act, Chapter 2M. As I said, most organizations on this call may not have that applicable to them. But the slide I actually wanted to talk to is the one after this, Elizabeth, which is providing assurance. Now, this is essentially what's coming down the track. Not only are organizations going to have to be mandatorily reporting this information in the coming years in their financials, but they're also going to have this assured. And as you can see, first off the rank will be assurance over disclosures related to governance and strategy and risks over climate risk and opportunity, and there down at the bottom, sort of third row from the bottom, scope 1 and 2 emissions, leading into reasonable assurance and over time, and then incorporating scope 3 emissions down the track. I guess the takeaway from this is that if you're not already captured by a regime that requires mandatory climate reporting in the next financial year, someone's going to ask it of you at some point, and eventually it's going to be subjected to an assurance regime in 2 or 3 years. So the takeaway really is that you really need to be going into these financial reporting periods thinking about a roadmap towards measuring your carbon and starting to articulate what your governance and strategy and risks and opportunities are around climate and climate related risk. That's essentially my takeaway for those um, on this webinar today. Now, I'm going to pause at this point because some of this information is kind of not relevant to the point I'm trying to make. I'm going to ask Elizabeth to jump ahead to the roadmap slide, which I think is kind of where I'll leave the topic. Elizabeth, the roadmap slide is the next one, which is that one. BDO has developed a series of best practice roadmap for organizations who are preparing for mandatory climate reporting. As I said, you may not yet be captured as a not-for-profit, but you certainly will be at some point. But even if you are being, if you're not preparing for a mandatory disclosure regime just yet, it will come. But most organizations in the value chain will start to ask you information of this, and people who are asking for information on climate and emissions, information related to grants and to philanthropic will want this information. And the first steps in terms of your climate focus should be to put a roadmap together, because most carbon measurement roadmaps are a 2 to 3 year odyssey. You can't really do this in a couple of weeks. It can't really be done in a short period. And you want to actually start to understand what's in your boundary, what's your basis of measurement going to be, and then giving scope 1 and 2 emissions calculations a hot go first, followed by scope 3 either a year later or down the track, depending on the need for that information. And really, that's the takeaway for not-for-profits at this point: is this is on the horizon, and if it hasn't already hit you from a mandatory point of view, it will at some point. So it's time to start putting this on your agenda as a focus area. I think I'll leave it at that in the interest of time, Elizabeth, and move forward to the next slide in terms of the general financial reporting update. So the general reporting update is just an update on where we are on the not-for-profit reporting frameworks. This is also a change that's coming for the not-for-profit reporting industries. You may be aware that the AASB, or the Accounting Standards Board, along with the charities regulators, is working towards a Tier 3 reporting framework for these entities. So currently, under the charities regulation on the left-hand side of the slide, large and medium-sized charities have to essentially comply with um, um, the Australian accounting standards if the charity is a reporting entity. And for most of the large and medium charities, that probably means they are reporting, and they'll have to be doing some sort of um, tier 1 or tier 2 general purpose financial reporting. Um, the proposed requirements that are coming down the track is essentially to introduce a third tier of reporting, which is essentially a form of general purpose reporting, but that has simplified accounting for some aspects of the accounting standards. And I think this has been called for by the industry for some time. Everybody's sort of really looking forward to this. And that'll allow these large and medium charities to essentially step down from full recognition and measurement under accounting standards to a variation of a tier 3 simplified accounting. Now, it's not without controversy. And where we are currently in the cycle is that these proposals are essentially open for comment. There's a series of exposure drafts that are open for comment until I think it's the 28th of February 2025. Heading into the year end, where you're preparing for these as not-for-profits for 31 December 24 reporting. Does it have an impact on your current reporting? No. But will it have an impact going forward? Yes. And I think the message for not-for-profits in this situation is to get active on this, because it'll have an impact on you going forward. It may give you some relief down the track, but that may not give you all the relief you're looking for. So really the action item for all our not-for-profit constituents on the call today is essentially to be aware of this, but also to actively participate in this exposure draft process so that we get the best outcome for these 3 tiers of reporting for these charities going forward. It is a generational shift in reporting for charities under the ACNC. So I'd hate to be in a situation where the standards are finalized and then the cohort of not-for-profits on this call um, don't or aren't happy with the outcome once these standards are finalized. So essentially, take an active role in this. The ED 335, which is on the slide right now, essentially is a link to some of the more um, relevant exposure drafts. Um, and I think the point I wanted to make here is find the number 334, 335 that is the exposure draft that's relevant to you, understand what's going on in there, and take a decision on whether you want to be involved in that process to see that through. On the next slide, Elizabeth, I think we've put some key recognition differences that are currently being proposed. Now, these are the really juicy ones. The tier three proposals that are being put out by the Australian Accounting Standards Board isn't just reduced disclosure or simplified disclosure. There are actually some recognition and measurement differences. So you would actually do the accounting difference for some aspects of accounting. Things like deferred tax, research and development expenditure, borrowing costs, and the timing of revenue recognition would change under the supposed tier three. One of the more exciting ones is that all leases would be off balance sheet. So this is almost going back to the old operating leases model for tier three reporting only. And then there would also be some allowances on measurement that would make it a little bit easier for entities reporting under tier three, things related to provisions, the discounting of provisions, and some simplifications in terms of impairment and interest rate formulations, as well as some exemptions on fair value accounting. They are actually big adjustments from what is currently done under full IFRS or full GAAP for these entities. But I think that there's a cohort of the not-for-profit sector who actually want this to go a bit further. And that's why I'm encouraging you to get involved in this process, because now's the time to essentially engage on this and make sure you get in the outcome that you want in terms of tier three. Um, I think that's probably all I wanted to cover under that section because it doesn't have a direct impact on current reporting. Um, there's a series of slides we've included in your pack with a bit more detail in it that you can go through yourself, but I would actually just download the exposure drafts themselves from the website if you haven't already done so. And then in terms of new Australian accounting standards, this is a section I'd like to kind of jump through really quickly in terms of actual direct impacting 31 December 24 reporting. And the first one is the presentation of financial statements, and more particularly the current and non-current classification of liabilities. This has been a long-term time coming. I think on the next slide, we've actually got the application date of the changes that we're referring to here. So there we go. So 31 December 24 reporters. So if you essentially have a year end 24 as a not-for-profit or as any entity complying with the standard has been a long time coming and will be first cab off the rank, December year ends. It will require you to reassess essentially the classification or presentation of all your liabilities between current and non-current. Um, and it not only changes some of the key principles, or at least locks down some of the key principles, but it'll also require you to restate comparative if there's a change in classification between current and non-current. So there's a little bit of work to be done here. On the next slide is one of the key aspects of this change, and that is basically you have to assess the impact of covenants and covenant tests, and the basis of that test is very clearly linked in these amendments to the standard about when the covenant test is required, whether that test is before or after your reporting date. Some of this you might be doing already in your classifications between current and non-current liabilities, um, but you may not be getting it right because the tests weren't clear in the accounting standards before, and there are now very specific rules about when you do the covenant test for borrowings and how you assess that on current and non-current disclosure. And then on the next slide are some other sort of key components related to breaches of covenants, rights of rollovers, and waiver and grace periods. Now, there are a lot of not-for-profits and entities out there that have long-term borrowings or borrowings that have covenants, covenant tests, that have breached covenant tests, that have rollover rights and waivers. None of these concepts were locked down in the accounting standards previously to these changes. These changes are now in the standard. They're effective from 31 December 24 for December year ends. It requires a reassessment of whether these are current or non-current based on these rights, and restatement of prior periods where that applies. So if there's anything you want to spend some time on for this reporting period, getting ready, it's this aspect, especially if you've got borrowings on your balance sheet. And BDO has a fairly comprehensive guide, which is the one on the slide right now, which I think you can download free of charge off the web. It's got a great decision tree in there that you can actually use to essentially apply the new concepts and basically assess whether you're getting your classification of your liabilities correct. They've only given me 30 minutes. I actually think they gave me 20, so I'm already behind. So I will at a galloping horse pace just cover off the fact that the presentation and disclosure of financial statements is going to change in future years. It's not going to change at 31 December 24. It is a future year standard that's coming. This is IFRS 18 or AASB 18 in Australia. The entire presentation and classification of items in the statement of profit and loss is going to change. This will impact a number of not-for-profits, in fact, all not-for-profits. It will also change the way you do subtotaling. And there will also be some impacts on things like associate accounting, which I know is quite prevalent in the not-for-profit sector. Why do you need to know about this for 31 December 24 financial statements? Although it doesn't impact the current year's financial presentation of the statement of profit and loss, because it's a new standard that is already issued and has an effective date already determined in the future, you actually have to disclose the impact of this new standard in your current year financials if you're reporting under Tier 1, so full IFRS general purpose disclosure. So those are your Tier 1 AC&C general purpose financials. And similar to the previous section, we've got a wonderful guide here for you to download, which is on the next slide, that you can start having a look. You can see there that the impact will be from 2027, but because the standards are already effective, you need to start making the disclosures in your financials currently about what that might look like if you're under Tier 1 general purpose reporting. And then finally, to close off with a minute to go before 5:30 is links to our general not-for-profit insights available on our website at BDO. This is things like our training, our thought leadership, and a couple of topics that we've issued in the last 6 months or so that you may be able to have a look at. With that, I will say back to you, Elizabeth,
Kevin,
exactly
that
on
was
time.
fantastic. Don't disappear. You actually had a few more minutes, so you're okay. Um,
Right.
Aletta obviously didn't trust you staying on time, so told you you had less time than what you actually had.
It was actually
That
that I committed to a less time when I spoke to the organizers this morning. So it was a self-imposed limit.
Thank you. That was really helpful. Couple of questions that have just come up. In regards to the ESG reporting, um, not-for-profits that receive government funding, will they have to report Scope 2 type emissions to government agencies?
Good question. It everyone's favorite IFRS answer. It depends. It depends essentially on the terms of the grant, first of all. So you really need to evaluate one, do I have to in terms of the contractual grant? But then two, also, are you in the value chain where they're going to ask information of you because they need information for their calculations? So they may come at you, it might not be in your actual grant agreement, but as an important player in the value chain, they may seek information from you. So the answer is probably yes and yes. It's just a matter of whether the obligation to report is contractual, whether it is because you're a nice guy and you want to deal with your stakeholders because they're asking information of you. Um, Getting grant funding from government doesn't force you to do it mandatorily in your financials yet, unless you're covered by a mandatory regime like the public sector entities are and like the private sectors are under the Corps Act. But it really depends on what's the enabling thing that you are bound by, contract, relationship, or some sort of reporting regime, and whether one of those three things forces you to report.
Thank you.
Hope that
Fantastic.
answers the question.
Um, yes, and I guess, yeah, we can consult further with your team if further questions arise. Also, another question on the Tier 3 reporting. If you're a not-for-profit who is still preparing special purpose financial statements, would you recommend that they continue to prepare special purpose financial statements or transition to simplified disclosures general purpose?
Whew. That's like giving general advice to a financial advice question. Um, the answer to that is a lot more nuanced and a lot more complicated. I should probably say that I'll answer that first as a personal view, not necessarily a BDO view. I wouldn't necessarily transition immediately if you're preparing special purpose, and that's mostly because the exposure drafts are still that. They're exposure drafts. So we don't quite know where this is going to land yet. I think the standard setter will tell you they know where they're going with this, but it is in an exposure drafts phase. So I'd say get some proper advice about your specific situation first and foremost. Um, but my more fancy answer is special purpose is on the way out. If you are in the large charity and medium charity box, you're going to have to transition to something, at least based on where the exposure draft is going. So I would at least evaluate what the transition looks like. And I'm choosing my words carefully there. Don't transition at 31 December, but evaluate what your options are and what does that look like. And perhaps maybe early in the next year, if you're a December report, you can start to understand where you would go in consultation either with us or with your accounting advisors or even your auditors. So I'll kind of pull that back again and say, just understand the transition options and where it's going. Don't jump too quickly into it yet. Let the standards get finalized. But large and medium charities, by definition, have to transition to something. So you need to put that on your agenda and start to think about it. Yes.
Fantastic. Well, thank you very much for all of your time. As Kevin mentioned, we're constantly updating our not for profit insights page with hot topics that we see are impacting not for profit. So, a couple of recent ones we've created articles about was accounting for discounted or donated inventories received by not for profit entities, and also accounting for volunteer services received by not for profit entities. And then also tax changes. We're not talking about tax here today, but in previous webinars, and we've had recent tax webinars specific for not for profit entities. So you can find all of those on our website. Thank you so much for your time today. If anybody does have any other questions, please raise them in the questions chat, and we can come back to you after this webinar. Thanks, Kevin.
Thank you, Elizabeth, and thanks for having me.
Great to have you. So I will welcome Oliver on the screen now, who will provide us an investment market update.
Thanks, Elizabeth. Nice to be here. Thanks everyone for joining. As you can see, that photo on your screen right now is before I shaved off my Movember growth. Um, yeah. So look, my name's Ollie Straker. I'm in the private wealth team. So I look after investments for profits, so high net worth families, but also not for profits. It's some of my favorite work is investing money on behalf of charities because you meet up with the clients and seeing where the investment returns get put back to use in the community is fantastic. So yeah, pleasure to be here.
Yeah, and thank you very much. I think overall, what I've seen from my not-for-profits, it has been a good year for investments this year. But I know there's also a lot of not-for-profits who are looking at how well their investments are being managed, and that's exactly what your team does. And you've assisted some of my clients in ensuring that they have the right portfolios and the right investment manager. So I'll hand it over to you now, and I'll disappear off screen. Thanks, Oliver.
Thanks, Elizabeth. Just get you to go to the next slide. Thanks. So look, I'm going to talk about some investments in my presentation. Obviously, it's general advice only. If you want specific advice, please do reach out. We would love to. So a little bit about our team. We look after about 1.5 billion. We've got 25 in our team, and as I said, the clients range from high net worth families all the way up to not-for-profits. And some of the greatest work that we've done is actually introducing some of those high net worth families to some of our charitable clients. So we do create bespoke investment solutions. So unlike some of the older business models in financial planning, we don't sell product, and we come up with bespoke portfolios for each one of our clients. This is how we structure a portfolio or go through the whole process. I'll just in the interest of time, I think I've only got 15 minutes. I'll just go through this quite quickly. So when we meet up with a not-for-profit, the first thing we want to do is look at what your objectives are over the next 5, 10, 15 plus years. If your objective was, we've got a bit of surplus on the balance sheet, but we need 70% of that in the next few years, I wouldn't be telling you to invest in shares. But the longer term you can look with those funds, and say we're looking at a school foundation, for example, and those funds are going to be funding scholarships for in perpetuity for 20 plus years, that's when you can start to look up the risk spectrum in shares and infrastructure, property, things like that. So we meet with you in the first meeting to determine your objective. Whatever flows out of that, we then look at the governance side of things. So we'll look at your investment policy statement to make sure that it's capturing what your financial objectives are. Maybe you've got some ESG concerns, you don't want to invest in tobacco, coal, things like that. And then we also educate the committee and the board. Then step 3, we actually do back testing on a potential portfolio, and we create the investment strategy and the individual investments that have flown out of the investment policy statement. Number 4, we invest those funds. And then number 5, our ongoing relationship starts with the charity. So we usually meet up with, depending on how big the charity is, we might meet up with the CEO, CFO, Finance and Audit and Risk Committee, and Investment Committee, or the whole board. And we meet with them. Some clients meet up with us monthly, quarterly, half yearly, yearly. We help with the refund of franking credits, and then we check in each year with that investment policy statement to make sure that the actual investment strategy still captures what the charity is trying to achieve from an objective standpoint. All right, so a bit of a market update in Australia. So what the market over the past few months has been trying to work out is what's inflation doing and when are interest rates going down. It's really hard to summarize many of the nuances in the market in 15 minutes, but I'm just going to try and touch on a few of the big things. So the market is always trying to figure out when interest rates are going to be getting cut. Now, a few months ago, that was looking like February, March, and it changes day to day, but at the moment it's looking more like April, May because of the latest inflation print we had. What's been really hard to get down, and probably what some of the charities online are actually looking at, is housing and rents. They're just remaining stubbornly high. So a lot of the new projects that you see coming online at the moment, it's taken a long time to get approvals for those. Labor costs are going up, material costs have gone up, which is flowing onto the price of housing, which means those bits of the inflation figure. Remember, the consumer price index is like a big basket of goods, and it's amazing the way they calculate it. Obviously, your big ticket items are energy, housing, and rents, but it can go all the way down to things like toothpaste, and that all gets bundled up in that basket. And then you go year on year, what have those prices moved? And yeah, the housing and the rents have been sticking are really sticky. So the market has since priced out those next interest rates cuts to more like mid next year, which in turn puts pressures on asset prices and puts pressures on the average Australian household. So that's something we've been keeping an eye on. Also, material costs have been coming off a little bit because of the Chinese economy. So the Chinese economy has been slowing by quite a lot, which creates less demand for coal and iron, which is a huge part of the Australian economy, which has been putting stress on the ASX 200 as well. And I'll just get you to go to the next slide, Elizabeth. So what that means is unemployment has been ticking up and wage growth has been flattening and actually going down a little bit. And what's a little bit alarming is the wage growth in line with how much prices have gone up means real wages. That means if your salary's only gone up by 4%, but the price of everything's gone up by 5, then you're actually going backwards. And there's some pretty poor statistics, particularly in Australia over the past 4 years, that real wages have been pretty stagnant. So that is of concern. So that's what's looking forward. Looking backwards, as Elizabeth said, it's been a great time to be invested, particularly in global markets. And if I just get you to go to the next slide, Elizabeth, if your portfolios are well diversified, you should have investments in Australia, you should have investments globally. What's been happening over the past 12 months is, and I think when I was doing this webinar 12 months ago, the market was really concerned at how quickly interest rates had come up and inflation wasn't moving, which meant that you get what's called a hard landing. And that's where we have to cut interest rates. We have to keep increasing interest rates, which obviously puts pressure on the average Australian household, the average business, because a lot of businesses have debt. And that's when you can get a hard landing. Now, amazingly, the past 12 months, interest rates, particularly globally, have been coming down faster than Australia. And we haven't seen a recession yet in the US. New Zealand is looking like they're going into a recession. But in the US, if they can achieve the soft landing, which is where inflation gets back in where they want it, which is between 2% and 2.5%, and they don't get a recession, that is a soft landing. It looks like we're getting close, and that's why the market has just ripped ahead, because the market 12 months ago was predicting a recession, or like a 70% chance of recession in the US. Now, I just want to speak briefly because a lot of our clients are asking about this. Obviously, Trump has been elected, and I'm not going to talk politics at all, but it's pretty amazing to see. Doesn't really matter what president is in the US. They do have amazing power on the short term, but the old saying is, don't try and time the market. It's time in the market. So here I've got a graph of $1,000 invested in 1933, just in the top 500 companies in the US. And you can imagine how those companies have changed over time. So you probably had military companies right at the top at one point. You would have had oil and gas companies at the top at one point, and now you've got the big tech companies at the top. Now in the blue, you've got Democratic presidencies, and then in the red, you've got a Republican presidency. And you can see $1,000 invested in 1933, and I believe this only goes up to 2019. And this has since ripped ahead, so it'll be a lot more. But even in 2019, $1,000 reinvested from 1933 now equals $10 million. And you can see if you zoomed right into some of those periods, it would be swinging up and down by 10%, then -5, or 20%, then -20 in the GFC. But you can see over time, the market just produces incredible results. So I just wanted to highlight that even though Trump has been elected, the US market over the long term and our market produces amazing results. Thanks, Elizabeth. So the growth is picking up, but is a soft landing possible, just like what I was saying before? So you can see these bar charts. This has each country, and each bar represents what the forward prospects of each market is. So you can see the Australian market looks like it's going to pick up, or at least the economists have it picking up in the fourth quarter of 2025 in that grey bar. And the US seems to be pretty stable at the moment as well. Japan's dropping off a bit, and China's still quite high, but as I said, stagnant. The eurozone is still struggling with a bit of inflation, so their growth is not as strong as ours or the US. So the market is looking at positive growth in each one of those economies over the next few quarters, which is pretty remarkable considering how high interest rates have got. Remembering a recession is defined as 2 periods of negative GDP growth. So at the moment, the market is not predicting a recession. So that is good news, and that would equal a soft landing if we can get inflation to those targeted bands. Thanks, Elizabeth. So the recession probabilities, this is really interesting. Don't take it as gospel because the saying goes, economists are about as good as the weatherman. They get it wrong all the time. Like I said, this time last year they had a US at a 70% probability of recession, and that didn't happen. But at the moment, a combined take of the economist is that Italy's up there at 38%, the US is at about 30%, we're sitting at about, what's that, 28, and down the bottom you can see like Indonesia and some of those emerging markets are a lot lower chance of going into recession. So that's good as an investor. Now the market's probably priced a fair bit of that in, as you've probably seen in your portfolios if you've owned any US or Australian shares. And I've just highlighted on the left the nominal GDP of the US compared to some other economies. The US is an absolute beast of an economy. It makes up about 70% of the market capitalization of total listed markets, so it is massive, and it's why we do invest if it's correct for your portfolio and your risk profile. We do invest in the US a fair bit. Thanks, Elizabeth. So, opportunities for not-for-profits. Now, remember, this is not advice, but some things we've been doing over the past few years, depending on the charity's risk profile. So, if it made sense to have a more growthy portfolio, say 60, 70% growth, some areas of markets we've been looking at is on the defensive side of the portfolio. As interest rates have come up, there are some pretty attractive bonds getting floated, particularly recently. Commonwealth Bank issued a bond last week that I think ended up getting priced at around 6.1% for 10 years. Now, if you're a charity where you don't need to call on that bond, and then we think 6.1% is quite attractive for the next 10 years. We hedge a bond portfolios where we have some fixed rate and some floating rate bonds. So, for example, we buy that on the fixed side, but then we also buy a floating rate one. So if interest rates come back up, so does your yield. Hybrids also look quite attractive on the defensive side of portfolios. They give you franking credits, and grossing them up for franking credits, there are some out there at the moment that have running yields of over 8%. So we quite like those as well. On the growth side of portfolios, we have been favoring quality companies. And when we talk about quality, there's three metrics that we usually look at: return on equity, recurring revenue growth, apologies, and then a low leverage balance sheet. So that's low debt, basically. And that's produced pretty good results as well. Remember, it's not financial advice. If you do want us to take a look at your portfolios, please do reach out. Next one, Elizabeth. Just wary of time.
That was your last slide, Oliver.
Great. Sorry, it probably felt like I ripped through that. There's a lot to get through, but
No, that was
yeah, thanks
fantastic.
everyone.
That was excellent. Thank you very much. No questions have come through, but I do really like the analogy you used of investment or economists being similar to weathermen. And if I'm based in Melbourne, if you're in Melbourne, it's very hard to predict the weather. I
That's
think they
right.
have a lot more luck in Queensland, right, Oliver?
That's right. Yeah, hot and steamy.
Thank you very much. Really appreciate your
Great.
presentation today. That was fantastic. And Brent, over to you. So we brought Brent in today as cyber security, as I mentioned earlier, is a really key topic and a risk impacting all industries, but in particular not for profit due to the amount of data the not for profits hold. Also, without stealing your thunder, it is an ACNC focus area as well. So I'll hand it over to you now, Brent. Thank you.
Thank you, Elizabeth, and also thank you everybody for having me today. My name is Brent Letson. I'm a director in the Melbourne office in BDO Digital. One of the key focuses that we have in Melbourne is cybersecurity, and particularly around cybersecurity risk and then also business resilience. There are some key security trends that are impacting the not-for-profit sector. They're those five factors that you can see on screen at the moment. So what we are seeing across industry is increased cyber threat. So there'd be no surprise to anyone on this webinar. There's an overall rise in cyber attacks, particularly with ransomware and then with phishing attempts, and they pose a constant threat. not-for-profits are often seen as easier targets relative to other industries because of the limited defences and the overall level of investment relative to other industries. As Elizabeth mentioned before, there's also the sensitive data factor that comes into play with that because of the amount of PII data that is held, private data that is held, and sensitive data. That also creates an additional threat and makes for a targeted um, for not for profits to be potentially targeted as well. What we see with a lot of the cybersecurity attacks or the breaches that happen are often due to social engineering attacks. So that's those the bogus emails, the links that are clicked on, where people have effectively been fooled or been tricked by a social engineering attempt, which then leads to a data breach. Um, so what's coupled with that is awareness and training. They are crucial. Often humans are the weak point as it relates to cybersecurity. So training and awareness are really key, but often lacking. Then coupled with that, what we also see is a lower maturity across the board as it relates to policies and procedures um, with regards to cybersecurity practices as well. So, and then also what to do in the event of a cybersecurity attack. So, what we're talking about here is how do we recover from that, and then what plans are in place as well. And often it's the case is where there are not clearly defined plans and procedures in place to recover from such an incident, then it can take longer to recover from that and then to restore those services. On top of that, obviously, there is a compliance focus um, from the regulator as well that we need to make sure that we're adhering to um, at all times. Uh, I'll just get you to jump to the. Oh, we have jumped to the next slide. Thank you, Elizabeth. So the ACNC have recently published their compliance focus for FY 24-25, and that relates to cybersecurity challenges, with those key focus areas being reviews, looking at the types of sensitive and personal information that is held, the the policies and procedures and the practices that sit around the collection, storage, and management, and also the disposal of electronic information, the management of sensitive and personal information, and then also the procedures that are in place in the case of a cybersecurity breach. That also pertains to viruses and cyber attacks, and then to then look at the training that employees and volunteers are receiving on how to avoid and also to manage cybersecurity threats. I'll just get you to jump to the next slide as well. Thank you. Brilliant. You are one step ahead. Other areas of focus that the ACNC is also looking at is they're seeking to understand how the activities that are undertaken by charities make them more vulnerable to cybersecurity risks. They're also looking at how charities mitigate the financial risks that arise from cybersecurity vulnerabilities, and then also looking in particular at third-party management. So what controls are in place where there are systems and where there are processes that may be outsourced, or there might be a platform that's actually managed by a third-party vendor, to ensure that the adequate third-party controls and management is in place. I'll just get you to jump to the next slide. Thank you. So what can we do about this? There's an ongoing challenge. Even without the compliance focus, there is an ongoing challenge to protect our organisations, and then also ensure that in the event of a cyber attack, that systems can be restored and we can get back online and then learn from that and then bolster operations as well. The big thing here, as I mentioned earlier, is often the vulnerability is around people, is around the social engineering attempts to get inside an organisation. So enhancing employee awareness and training is absolutely key to that. So promoting a culture of cybersecurity awareness amongst employees and volunteers, and conducting regular training sessions and on how to identify those social engineering attempts is really key. To prepare for the worst, ensuring that really robust cybersecurity policies are in place. So maintaining an up-to-date business continuity plan and maintaining an up-to-date disaster recovery plan is really key when or if an event occurs, that systems can be restored and you can get back online and get back to business as usual, and ensure that that the right protections are then in place following an incident. The other really key thing within this is around third-party management. So, and that's really key. So where there are systems they're not hosted on premise, that are they're hosted by a third party, to collaborate with that third party to ensure that they have suitable cybersecurity practices and processes in place, and then also to regularly assess and then monitor the third party's cybersecurity practices, and get that attestation and then confidence from those partners and vendors. I'll just jump to the next slide, please, Elizabeth. So this is something that we, BDO Digital, we partner with a lot of organisations and we help other not-for-profits. So I just wanted to share a quick case study today. So recently we have partnered with a healthcare not-for-profit. They asked us to conduct an information security management system gap analysis to look for areas for improvement within their cybersecurity practices. So BDO evaluated the organisation's existing controls and policies and procedures against industry standards. We identified several key areas needing improvement. We then helped that organisation by developing a risk management framework to identify and then mitigate their key security risks. We conducted some technical tests as well to ensure the effectiveness of those controls. We then put in place regular training programs for staff on cybersecurity threats and best practices, and then also did some technical work around securing that organisation's cloud services to protect their sensitive data and to ensure that they were compliant with regulations. The overall outcome of that was a significant improvement in their information security maturity. We helped to address the identified gaps. We enhanced their controls, and we also put in place an ongoing improvement plan to ensure that they were staying on top of that on an ongoing basis. I will just stop there. Thank you.
Thank you very much, Brent. That was very relevant to the not-for-profit sector, and appreciate your time today. We are right on the hour, so I will wrap up our presentation, our webinar now. A huge thank you to our presenters today. Kevin, who provided the ESG and sustainability and accounting standard update, Oliver with the investment update, and Brent on cyber. If anybody has any questions, please feel free to put them in the chat. We will share all of these slides with everyone who has registered for today's webinar. Also, I ask that if you have any other topics that you would like BDO to present on, please drop that in the chat also, so we can create future webinars that will be of assistance to you. So thank you very much. I hope everybody enjoys their day today, and thanks again. We'll see you next time.
Thanks, Elizabeth. Thanks, everyone.
Thank you.
Thank you.